Yesterday we called it negotiation by fire. Today it feels more like a kinetic trap. Welcome back to Market Lens. I'm Daniel Reed. It is Friday, May 8th, 2026. If you thought the 14-point MOU was a straight line to peace, the last 12 hours have been a brutal reality check. Iranian drones and missiles just targeted U.S. naval assets in the Gulf. The U.S. responded with self-defense strikes. And just like that, Brent crude is back screaming above $100 a barrel. But here is the logic that the mainstream media is missing. The market isn't panicking because of the missiles. It's repositioning because of the payrolls. Today, we saw 115,000 jobs added to the U.S. economy, nearly double the consensus. In a normal world, that's a victory. In a world with $100 oil and a naval exchange in the Persian Gulf, it's a Goldilocks scenario with a very sharp set of teeth. Today, we are looking at the calculated chaos in the Strait, the paradox of a resilient labor market, and why the defense AI pivot is the only bridge standing in a sea of red. Let's address the elephant in the room. The drones are back in the air. After the U.S. strike on that Iranian tanker yesterday, Tehran didn't back down. They launched a multi-vector drone and missile wave toward the U.S. Fifth Fleet. No hits, no casualties, but that's exactly the point. In my logic model, this is symmetry. Iran cannot sign a 14-point peace deal if they look like they've been bullied into it. They needed a kinetic response to save face domestically before they can move to the next stage of the MOU. The U.S. self-defense strikes were equally calculated. They didn't hit oil refineries, they hit the launch sites. This is a highly choreographed standoff, where both sides are communicating through explosions rather than cables. The 14-point MOU is not dead, it is pressure testing. The smart money knows that as long as the transit lines in the Strait of Hormuz aren't physically blocked, this is just diplomatic theater with live ammunition. However, the volatility tax is real. The VIX is creeping up, and the stability premium we discussed yesterday has been temporarily revoked. While the missiles were flying, the Bureau of Labor Statistics dropped a bombshell. 115,000 new jobs in April. The street was looking for 65,000. We beat it by almost 100%. On the surface, this is the soft landing dream. But look deeper into the sectoral rotation. We saw massive hiring in government-linked tech and healthcare, while manufacturing stayed flat. Why is this a paradox? Because a resilient job market gives the Federal Reserve hawkish permission. If the economy is adding 115,000 jobs, while oil is over $100, the Fed doesn't have to cut rates. In fact, they have the cover to keep them higher for longer to combat the energy-driven inflation we are seeing right now. This is why the 10-year yield is twitching. The market is realizing that good news is bad news if it leads to a stubborn Fed. We are in a resilience trap, where the strength of the American worker is actually preventing the interest rate relief that the tech sector is desperate for. Yesterday, we saw Brent crude dip below $100 and the market cheered. Today, that floor turned out to be a trapdoor. Oil is back at $102. This isn't just about the drone strikes. It's about inventory panic. Global shipping firms are now pricing in a permanent risk surcharge for the Strait of Hormuz. They are realizing that even if a deal is signed, the kinetic potential of the region has been permanently elevated. Look at the technicals. We've seen a bullish engulfing pattern on the crude charts. This suggests that the energy tax is going to be a persistent drag on the Q2 earnings cycle. For companies like Whirlpool, which we highlighted yesterday, this is a nightmare. Higher energy costs plus a higher for longer Fed equals a paralyzed consumer for big-ticket items. But for the energy majors and the resource tech sector, it's a margin expansion story. We are seeing a K-shaped energy reality play out in real time. In a sea of red, where is the green? Look at the Pentagon 7. The $50 billion military AI integration we discussed yesterday is proving to be the ultimate hedge. While the Nikkei retreated and the Nasdaq pulled back, the companies at the heart of the algorithmic battlefield, NVIDIA, Palantir, and the defense-integrated tech giants, are showing massive relative strength. Why? Because conflict is their revenue driver. Every drone wave in the Gulf is a data point for the predictive AI models being deployed by the War Department. Every self-defense strike is a validation of the automated tactical loop. We are seeing a fundamental shift in how safety is defined in the market. It used to be gold and bonds. In 2026, safety is mission-critical AI. Investors are realizing that the government will never stop spending on these systems, regardless of what the Fed does with rates. This is the decoupling we've been waiting for. Let's look at the winners and losers of the day. Revvity is up 14%. They reported results that aligned with expectations, but their guidance on AI-driven life sciences sent the stock into orbit. This is the service layer boom we discussed yesterday with DoorDash. If you can provide efficiency through data, the market will pay a premium. On the other hand, look at Calumet, CLMT, a $317 million net loss. They mentioned that their Montana renewables facility is finally coming back online, but the refining margin squeeze is brutal. The logic here is clear. Traditional energy infrastructure is suffering from the volatility, while digital intelligence is thriving. We are seeing the hard asset economy struggle to keep up with the algorithmic economy. The turnaround story in physical refining is taking too long for a market that is moving at the speed of a drone strike. So what happens over the weekend? We are watching the 30-day window very closely. Scenario A, the retaliation spiral, 20% probability. If Iran manages to hit a U.S. vessel, or if Israel enters the kinetic loop, the 14-point MOU is incinerated. Oil gaps to $120. The S&P 500 tests the 5,300 support level. This is the black swan we must hedge for. Scenario B, the fragile freeze, 60% probability. Tehran and Washington continue their kinetic dialogue, striking back and forth but avoiding red lines, while diplomats keep the 14-point framework alive. The market continues to grind sideways, anchored by the jobs data and the defense AI strength. Scenario C, the sudden signature, 20% probability. Tehran realizes they cannot win a war of attrition against $50 billion AI defense systems and signs the 30-day freeze on Sunday night. Monday morning would be a gap-up of historic proportions. We are betting on Scenario B. The Kinetic Trap is designed to keep everyone guessing, but the underlying data, the payrolls and the AI integration, points toward a resilient, if volatile, base. The 2026 market is a masterclass in multimodal risk. You have to understand the flight path of a drone as well as the yield curve. But remember, the smart money doesn't trade on the news. They trade on the logical response to the news. The response today is clear. The U.S. economy is too strong to collapse. The Pentagon is too invested in AI to fail, and energy is too volatile to ignore. Stay sharp. The weekend is the dark zone for geopolitics. Watch the Sunday futures and the crude oil open. I'm Daniel Reed. This has been Market Lens. Thank you for trusting us with your intelligence. Hit that subscribe button. Next week, we go deep into the yen carry trade collapse and what it means for your Asian tech holdings. Stay logical. I'll see you later with more insights.